The final inspection is passed. The punch list is signed. The crew is packing up and heading home. But for the contractor, finishing the work doesn't actually mean getting paid. Instead, hitting substantial completion triggers a timeline void, a silent period stretching 60 to 90 days between finishing the physical labor and actually receiving the final check. This document shows the structural cause of that void. In standard commercial and public AIA contracts, project owners legally hold back 5 to 10% of the total contract value, known as retainage, to ensure the job is completed to specification. Many contractors treat this final check as future profit or bonus money. They fail to realize it is critical operating capital, the exact funds required to survive the immediate post-project cash drought. To see how damaging this is, we can break down a standard $1 million contract. If an owner holds a 10% retainage, $100,000 is immediately frozen the moment the job finishes. That frozen $100,000 represents real operational costs. It equals an entire quarter of payroll for a 5-person crew, not to mention the cash needed for materials and equipment logistics. This overlap creates the mobilization gap. To start the next project, you have to pay upfront for surety bonds, permits, and heavy equipment transport, all while your cash from the last project is still locked in the void. Consistently bleeding cash to cover this gap leads to uncontrolled growth and severe cash flow mismanagement. Over a 2-decade span, 80% of construction firms fail precisely because they run out of liquidity between jobs. Ignoring the retainage gap is a mathematical trap. Surviving in commercial construction requires a deliberate financial mechanism to cross that void. Retainage financing acts as the primary bridge across that void. It functions by unlocking capital you have already earned, converting a pending contract line item into immediate usable cash. This illustrates accounts receivable financing. You submit an approved payment application, and a lender advances 80. To approve this financing so quickly, alternative lenders look at your debt service coverage ratio, a metric verifying that your current incoming cash can comfortably cover the financing fees. You only need a strict 5-document checklist to apply: 3 months of business bank statements, 1 year of tax returns, an ID, a voided check, and your signed AIA payment application. Submitting this checklist triggers the first underwriting filter. An algorithm matches your specific contract to an industry-focused lender who actually understands how construction retainage mechanics work. The second filter is your credit score. A score above 650 unlocks prime rates, while sub-600 scores trigger alternative pathways. The third evaluates loan size. Contractors typically fall into Track A, handling cash advances from $25,000 to $250,000. By assembling this exact package and feeding it through these 3 algorithmic filters, alternative lenders compress a months-long traditional bank review into mere days. A signed punch list and an owner's 10% contractual hold should never paralyze your crew's ability to mobilize for the next job. To build your bridge across the void, visit the BusinessLoan.Directory platform and specify that you need retainage financing. Pre-qualification takes exactly 2 minutes. There are no upfront costs, using a soft credit inquiry to completely protect your score. The platform instantly analyzes your needs and matches you with a lender perfectly positioned to advance capital against your specific contract receivables. Mastering retainage financing closes the timeline void. It ensures your operating capital scales precisely as fast as your ability to build.